Today we're going to talk about what usually happens to a stock after earnings. Very often, the price does not stop moving on the earnings day. Instead, it continues to trend for weeks or even months after the report. This behavior is called post-earnings announcement drift, or simply drift. In simple terms, drift shows how investors typically overreact or underreact to earnings and how prices tend to move afterward. To understand drift, we look at a stock's earnings history over time. The tool analyzes either 20 or 40 past quarters, which is about 5 to 10 years of data. For each quarter, it measures the stock's price reaction during the first 24 hours after earnings. That first reaction tells us a lot about how investors process the news. Each quarter is then placed into one of 4 drift types based on 2 things: whether the reaction was positive or negative, and whether investors overreacted or underreacted. Drift A means earnings were positive and investors underreacted. Drift B means earnings were positive, but investors overreacted. Drift C is a negative reaction with overreaction. Drift D is a negative reaction with underreaction. These 4 groups help us understand how price usually behaves after earnings in different situations. In this Apple example, the analysis is based on 40 past quarters. Out of those 40 quarters, 13 fall into Drift A, which is positive underreaction. For Drift A, the tool calculates 3 key paths using those 13 historical samples. The yellow line represents the average move, or the mean. This shows where Apple typically trades over the quarter when this type of drift occurs. The green line shows the maximum historical move. The red line shows the minimum historical move. Together, these 3 lines form the drift cone you see on the chart. The tool also measures how reliable this cone is. In this case, Drift A has an accuracy of 85.71%. That means that historically, when Apple was in this exact drift scenario, price stayed inside this projected range more than 85% of the time. For the current quarter, Apple is in Drift B, which represents a positive overreaction. This means investors reacted positively to earnings at first, but historically, this type of reaction tends to be too optimistic. As a result, once the initial excitement fades, investors gradually start to sell, and price often drifts lower over the remainder of the quarter. Looking at the historical data, when Apple falls into Drift B, the average move is about 11.3%. The accuracy for this drift is 73%, meaning that in nearly 3/4 of past cases, price stayed within the projected drift range shown on the chart. The tool also lets us look back at history. We can see the current quarter, recent quarters, or go back 20 or even 40 quarters to see how price behaved in similar situations. To make the analysis even clearer, the tool can add standard deviation levels. These show typical price ranges, such as plus or minus 1 or 2 standard deviations. For example, the -1 standard deviation level often acts as a natural mean reversion area, where price tends to stabilize or bounce in many historical cases. In addition to earnings-based drift, there is also seasonal drift. Seasonal drift shows how a stock typically performs during different parts of the year, such as winter, spring, summer, or fall. This is based on seasonality, not investor reaction, and it can be displayed alongside earnings drift for extra context. You can also display the 40-quarter drift and 20-quarter drift on the chart simultaneously, and additionally, you can add the seasonal drift, which accounts for seasonal price fluctuations. In a stock screener, drift can help identify potentially profitable stocks by filtering for the type of drift, positive or negative, overreaction or underreaction, the forecast accuracy, and the distance of the price from the end of the drift. The most attractive opportunities are those with positive underreaction or negative underreaction, as investors often underreact, creating potential for favorable price movements. In summary, drift is not a prediction. It is a statistical framework that helps us understand how stocks typically behave after earnings announcements. When combined with technical analysis and market context, it becomes a powerful tool for managing expectations, risks, and timing. Thank you for watching. Enjoy the platform and don't forget to do your own research.